This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello and welcome to this week's AJ Bell Money and Markets podcast. I'm Danni Hewson and I'm joined this week by the editor of Shares Magazine, Tom Sieber. Hi, Tom.
Hi, Danni. Pleasure to be here.
Now, Tom, I have to say that every week at the moment, I feel like I say, we've got a bumper episode, but every week it does seem to be true.
Yeah, absolutely. It's busy. And this week is packed full of US and UK earnings. We'll be picking through some of those that caught our eye, from the rejig of the menu at Starbucks from the new man in charge as sales keep falling, to a Netflix subscription slowdown, and Hollywood Bowl's mega strike. Plus, while we're talking about strikes, Boeing's brass will be fretting as industrial action by employees looks set to be extended as workers rejected a mega pay deal.
Yeah, markets have been a touch subdued this week, possibly because we're less than a week out from the UK's budget and less than 2 weeks from the US election. Dan Coatsworth has been chatting with Ron Temple, Chief Market Strategist at Lazar Asset Management, about what might happen to certain assets and sectors depending on which candidate gets to the White House.
Plus, Mike Asheley has his sights set on Boohoo, gold hits fresh record highs, and the value of lost pension pots in the UK has now hit a staggering £31 billion.
Okay, Tom, let's start with US markets. Where are we at in the calendar so far, and what has stood out for you?
Yeah, so we're, I don't know, I'm guessing here, but probably 15-20% into the US earnings season, and broadly it's been relatively positive. Although much of the big action is yet to come. The banks, as usual, kicks things off, and for the most part, they impressed, particularly the sector leader, JP Morgan, which reported total revenue of a little over 42 billion against a little under 39 billion in the same quarter a year ago. And that was ahead of the consensus expectation. And as well as seeing buoyant revenue in investment banking, the market was a bit surprised by the resilience of its net interest income. So that's a metric which measures the difference between what it charges on loans and what it pays out to depositors, given the firm had done a pretty good job of managing down expectations on this front. And we have had the first of the Magnificent Seven reporting as Tesla bounced back from what proved to be quite an underwhelming launch of its robo-taxi recently, and a very poor set of second quarter earnings. Its third quarter performance actually came in better than expected. There's still work for the company to do, and a big test now is whether or not it can come in ahead of last year's 1.8 million vehicle deliveries. The company will have to accelerate pretty fast in the fourth quarter to achieve this target.
Yeah, what do you think of the Cybertruck in terms of looks? Because it's finally profitable, which just, is a huge milestone really for them. But do you like it? I think it looks freaky.
Yeah, I think that feels like it's a bit of a wider consensus that people don't like the look of it. And yes, I don't know. I mean, it kind of looks like something out of RoboCop, which I don't know if that's what they're going for. But yeah, it's not necessarily to my taste.
And certainly Elon Musk is not to everyone's taste. I mean, he's certainly Marmite. And I've seen a couple of surveys recently about people and whether or not he is impacting their decision-making on buying Teslas. So, I mean, I think that's going to be a test for the shares over the next year or so. Just while we're talking about magnificent stocks, and for a while there, I thought Tesla was really on the edge of falling out of favor from that magnificent bunch. AI, is it likely to be a big story again? And when do we get the next lot?
Yeah, so undoubtedly AI will play a part. It feels like it will kind of from now onwards, really. And the next of the so-called Magnificent Seven to report is Google owner Alphabet on the 29th of October. And then you've got Microsoft and Meta on the 30th of October and Apple and Amazon on the 31st of October. So while there'll be attention obviously on the budget next week, there'll also be a lot of attention on what's happening in the US tech sector. I think of the names we've just mentioned, Apple is probably under the most pressure to demonstrate to the market exactly how AI can contribute to its growth. It's been a bit slower than some of the others to talk about AI in a lot of detail, and that brings with it some pressure. Investors will have to wait a fair bit longer for the big AI stock to report, though. So chipmaker Nvidia's earnings are not out until the 20th of November.
Interesting when you talk about Apple, because we had some UK retail sales figures out, I think it was last week, and it was tech stores that had done particularly well and sort of lifted things. And it was sales of the new iPhone that had really sort of got people into stores. So, I mean, that's pretty good for Apple, I would think.
Yeah, I mean, there's obviously been a debate, I think, with Apple about whether or not it's hit saturation point, whether or not people really need the next new iPhone. But clearly, there is a level of demand for it. But the good thing for Apple is that the more people who have an Apple handset, the more they're kind of plugged into the Apple ecosystem. And Apple makes a lot of money from services. So, like the music, offering, or Apple Pay. So, that is, an area which Apple has been prioritizing and has seen quite a lot of growth recently.
It's funny, I think you're either an Apple household or you're an Android household, and never the two shall meet. One that's really stood out for me is Coca-Cola, because I think off the back of Pepsi's results, which were disappointing, there had been expectation that maybe Coke wouldn't do quite as well. But because it still put its price up 10%, which seems crazy to me when you consider the current situation and people's budgetary issues, volumes fell by 1%, but still, obviously, off the back of that increase in prices, meant that sales are still looking pretty resilient. Now, it was quite interesting because that resilience was commented on by the chairman. I think the phrase was, in the face of a dynamic external environment, Coca-Cola is still doing well. I love that doublespeak for basically,
euphemism
are in trouble.
Yeah.
But they just seem to have been quite fleet of foot here. And I wonder how long that will continue if they keep putting prices up, because you had them really spending a huge amount of cash on marketing. I'm thinking about the Olympics and those gold smart water bottles that they were handing out to the big winners, sort of embedding in people's mind that sort of subliminal message that their products are the best and they are consumed by the best. And you also had in the United States, North America, where I think we certainly see from the likes of McDonald's and Pepsi that some of the consumers are really under pressure. So they've been putting into stores those smaller cans, which obviously are cheaper, so people can still have the treat, but they're not maybe having to spend as much. And also just in terms of their products, so they've got new formulas of Sprite and Fanta, which they've introduced in India and South Korea to appeal to taste there. And they're also sort of doubling down on flat drinks. So things like water, as we were just talking about, but also tea. And do you like iced tea? I've tried iced tea. I can't get on with it.
I do quite like. I mean, I'm a bit of an outlier in that I don't like tea, but I do quite like iced tea. And I'm sure you'll look at me as some disgust at that. But yeah, so I don't mind iced tea.
Well, that takes us neatly on to iced teas, iced coffees, spiced pumpkin lattes, and the insane menu that is Starbucks. And we had an update. We were expecting numbers from Starbucks, but we got the update on the numbers before they were due, because the new boss, Brian Niccol, who was brought in to turn things around at Starbucks because sales have been pretty torrid. And once again, we've seen another drop in sales, the steepest drop since the pandemic. But he has now said that he's going to completely simplify the menu. Effectively, what he's doing is he's bringing all the tools that he used when he was the boss of Chipotle, this is Brian Niccol, into Starbucks. And I've heard a lot of people talking about the fact that, you go into Starbucks, particularly I'm thinking about in the US, because I worked in a coffee shop in the US when I was 20, and it was insane. People would drive in from 6 o'clock in the morning. You did not get a chance to stop. People would come for their morning coffee, their bagel, and they would be in, they would be out, and they would be on their way. But Starbucks, because it's now got this insane menu, it's been taking longer and longer and longer to service people. So not only are people balking at the price, but they're also balking at the length of time that it's taking. He's got a huge job to do, but I suppose he's demonstrated he can do it.
I guess so. I mean, he's been paid very handsomely, isn't he, for, the efforts that he's putting in to try and turn Starbucks around. I mean, I think what you said about price is quite key, isn't it? Perhaps unlike Coke, they maybe don't have quite the level of pricing power. The brand isn't as strong. And if people don't want to pay Starbucks prices, there's plenty of other places they can go to get coffee. So he does have a big job to do.
He does. And it is all about the consumer and how the consumer is feeling. And of course, I'm just thinking, we're now 24th of October. We can now legitimately talk about Christmas. And it is going to be so important to hospitality venues, to retailers, and consumer confidence is going to be really important.
Undoubtedly, yeah. And we had a bit of an insight into consumer confidence in the UK this week. Two completely different companies, in fairness, both talking a bit about how consumers were feeling. So Lloyd's announced better than expected profits, and that was largely driven by lower impairments. So essentially that means there's fewer debts which they don't expect to be paid back. And it did note alongside the results, kind of feeding into that, I suppose, that it was seeing some signs of improved confidence among consumers. And with Hollywood Bowl, there were clear signs people are still happy to pay for a trip to the lanes as it chalked up another year of record revenue. So there are signs that, at least in some areas, there are improve. There's a bit of an improvement in the kind of consumer backdrop. Whether or not that be sufficient for companies to enjoy, and the companies you reference to enjoy a strong Christmas, I guess remains to be seen.
Yeah, I mean, we're talking consumers, we're talking about retail habits, consumer habits. And one man who's always seemed to have a real sense of what consumers want is Mike Asheley. Now, he obviously started with Sports Direct, that sort of pilot high, sell it cheap idea, then sort of shifted and was looking very much more at the sort of luxury end of things. Fraser's Group obviously was born. He stepped down from the sort of cut and thrust of being on the board of Fraser's Group. Was it back in 2022? And his son-in-law took over. Now, though, it looks like he wants to step in and take over as CEO of Boohoo. It's like he's got bored with retirement, and he's taken a look at what is going on at Boohoo, and he's decided that enough is enough. Open letter, which was released this morning, we're recording this on Thursday, and it landed, and it was just incendiary. I mean, I thought, wow, can you imagine what the rest of the board of Boohoo must think when they read this thing? He did not pull any punches, did it?
No, subtlety has never been his strong point, really, has it? But yeah, I think you're right. You get the sense that he was itching to get back to the coalface. And I mean, he'll have a lot to do if he is successful in becoming CEO of Boohoo. They've obviously had a very, very difficult time.
I mean, John Little was the guy that was brought in as CEO. I mean, he'd done so well as CEO at Primark. I mean, I think it was 9 years he was there. And during that time, they'd seen sales and profits more than double. So, this was a guy that understood retail, understood fast fashion. So you can look at the period of time he's been in charge for and think, okay, so he's had to deal with COVID. There's been a real issue with particularly young people and the amount of cash that they've got in their pockets. Then you've got the likes of Shein and Temu nibbling away. You've got the likes of Vinted, which I saw today, the latest funding round valued the company at 5 billion euros, a significant increase. And you just think, Boohoo is so big now. It's taken on so many brands. It's kind of lost itself. And I don't know, do you think Mike Ashley could be successful in turning things around? He's certainly had his fingers in a great number of pies, even if Mulberry didn't want him.
Yeah, that's true. I mean, he's well used to a business with lots of different brands, isn't he? From his time at Frasers, I suppose. And it does look like Boohoo is going to offload some of those brands and kind of simplify the business a bit. You wonder whether kind of how much longer the sort of Boohoo model and the fast fashion idea will continue. I mean, obviously, this doesn't apply to everybody, but the younger demographic are probably a bit more plugged into sort of sustainability and whether or not the idea of buying clothes to wear them a handful of times and then discarding them, doesn't really fit. And like you said, you've got sites like Vinted, which offer the opportunity to buy stuff secondhand. So yeah, it will be really interesting. It's certainly a very big challenge for him, and he'll need all of his experience and nous, I think, to, if he does take over, to get that one back on track.
Let's talk about the B word, Tom.
Yeah. Can't avoid it. Yeah, we can't get through another pod without talking budget speculation. And another colourful figure from the UK corporate world, the boss of Wetherspoons, is one of 170 CEOs and other executives from the hospitality sector who've called on the government to take action on business rates. So, Danny, what else has kind of been speculated ahead of next week?
Oh, there's so much speculation, and particularly small businesses. And, I've heard from so many of those hospitality businesses, small mum and pop retail businesses, talking about the impact of a 1% hike on employer national insurance, on top of the fact that we had, those huge national living wage increases and the expectation that there will be further increases, though not by quite the same amount that we saw the last couple of years. But just looking at the backdrop to what Rachel Reeves is going to have to deal with, we had some very handy public sector borrowing figures out earlier this week. And we're still talking about the fact that there's not as much coming in as is going out. And this has put clearly Rachel Reeves in a difficult situation. Some of it is of Labour's own making, because one of the big demands on the public purse has been those increases to public sector pay, although we then had the flip side in that strikes are not costing. But with all of this sort of in focus, there's also now growing speculation that the fiscal rules will be amended slightly so that in terms of day-to-day spend, they'll be tightened up, it looks like. So they won't, Rachel Reeves will say, look, we're not going to borrow money in order to fund day-to-day spending, but we're going to be able to turn the taps on a bit more in terms of investment, spending on things that help grow the company. And she's been helped by the fact that the IMF have upgraded the sort of economic trajectory for the UK by a little bit. And also they've said that it's welcome. This debate on whether to tear up the rules on debt was a welcome one, because public investment was badly needed in the UK, and was sort of pointing to the fact that the UK's investment had been lower than all other parts of the G7 for most of the last decade or so, and that, this will be welcome. And I think the fact that you've got words like this from the IMF is really important, because we know that Rachel Reeves and any chancellor going into that office since the Liz Truss budget must be thinking about the reaction of money markets and trying to take money markets with them on this journey so as not to, create another meltdown.
Absolutely. And I think that's a really key point. I think the money markets won't be spooked if the rules are loosened to allow for more investment, because they know that investment's required. So it is, if you're loosening the rules so you can cut taxes, that's probably a different story. But to do what the government potentially is, or it reportedly is going to do, then you'd think, you never want to predict things too much, but you'd think that wouldn't create too much disquiet.
Yes, there's so many potential minefields to have to walk through over the next few months and years for this Labour government. And obviously, the United States, that is one huge question mark: who is going to be in the White House from January. Before we hear Dan's interview with Lazar on the US election, I did want to just mention Boeing. I went to bed last night and there was this vote going on for this new 35% pay deal, which had been helped negotiate by one of the Biden administration, because clearly this is a massive issue for Boeing. We have the latest figures saying that they'd have an operating loss of over $6 billion in the last quarter. This just demonstrates the scale of the fact that you've got over 30,000 employees out of work. And I honestly thought that this time Kelly Ortberg was going to have got it sorted. But no, the union has come back. 64% voted against this pay deal, 35% over 4 years. Some of them saying, look, we're at the moment in a position of power, so why would we go back to work until we get what we want? They'd initially asked for 40, Boeing had lowballed it. Maybe if they'd come in higher to start with, none of this would have happened, but we are where we are. And I think you can't really soft pedal the importance of this company to other companies globally. And I'm thinking of the likes of Ryanair, who've already said, look, we're going to have to look at our schedules for next year because we're not getting the planes that we're expecting, but also suppliers. So Spirit, which makes the fuselages, was part of Boeing, was spun out, now potentially is going to be pulled back into Boeing. It has said that from Monday, it's going to start furloughing staff and may now have to start layoffs. And I went and had a look at Boeing Fields. I'm up in Seattle and took a look at the organization, and they've got these incredible showrooms full of all kinds of different businesses. So if you're going to buy a plane and you want to put in seats, overhead lockers, lights, all of that stuff, you can go and pick from different companies. And these are global companies. There were loads from the UK there. And you think, if these planes are not being made, then you can't be making the stuff that goes into the planes because it's just going to be sat in inventory. But then hopefully when all this ends, then that inventory will be needed. So you don't want to stop your business, but how do you press pause? For a lot of these businesses, it's a bit like the situation with the pandemic. They need to figure out a way to press pause.
Yeah, clearly it's having a huge impact. And with only days left in the US election campaign, Dan Coatsworth met up with Ron Temple, Chief Market Strategist at Lazar Asset Management, to discuss how the market has reacted to the campaign so far and what might happen to assets and certain sectors depending on whether Donald Trump or Kamala Harris is victorious on the 5th of November. Before we hear what Ron had to say, it's worth noting that this interview was recorded on the 17th of October, and a lot can happen in a few days during election campaigning. As it stands, the state of play hasn't changed too much in the subsequent days, but it might have changed by the time you hear this episode.
Well, as we're recording this, we've got US election polls implied, still very hard to call who's going to win. Markets don't seem to be particularly worried. We've got, the US S&P 500 and NASDAQ all seem to be doing, pushing ahead. No one seems to be too worried. We've seen some fluctuations on the sort of currency markets, but what's your sort of take on it? What do you think that we might see more volatility on the markets, perhaps in the days leading up to the election, not sort of a couple of weeks ahead.
Yeah, I think this election is a very tough one for markets because, as you say, it's on a razor's edge. If you look at the polls, Kamala Harris in the popular vote appears to be running about 2.5 to 3 percentage points ahead of Donald Trump nationally. But as you and your listeners likely know, that the U.S. election or the presidency is determined by the Electoral College, not by the popular vote. And if you look at how the Electoral College works, there's disproportionately high representation in the Electoral College of rural states, because each state in the Electoral College gets the number of seats that they have in the House combined with the Senate. Given that every state has 2 seats in the Senate, regardless of population, that skews the vote in favor of less populated states. So all in, right now we're right on that edge of the knife in terms of who would win. I would say if you basically forced me to say which campaign I would want to be in if I had to choose one, I still think, despite the betting markets, that Kamala Harris might be a slight favorite in this election, in part because it's very hard for polling to capture what voter turnout's likely to be. And my estimation would be that you're going to get more women who show up to vote, given the issue of reproductive rights. And Kamala Harris has a sizable lead over Donald Trump with women voters. One other quick thing to note on that front, by the way, is in 2020, only 66.8% of Americans voted, or 66.8% of the eligible voters, 66.8% of the eligible voters voted. That was the highest since 1900. But 70% of those people voted before Election Day. And the reason I bring that up is the election effectively started a month ago in the U.S. On September 16th. Pennsylvania started issuing ballots for early voting. So, this is an election that's already underway, and it's going to be really interesting to see how it plays out. But, I think right now the markets are not pricing an election outcome. In particular, even though the betting odds say Trump would win, I think the market does not reflect the consequences of a potential Trump victory in terms of trade policy, taxes, and regulation.
So obviously, if Donald Trump gets in, he wants to cut taxes. He seems to, am I right in saying that the markets would sort of view, or certainly companies would view him as more favorable from one perspective because of the less regulation, lower taxes. But he's very unpredictable. So I guess it's the big question around tariffs. Does that cause trade war? Is there a clear, obvious winner for the markets if, is there a clear winner for corporations between the two candidates? Which one do they actually prefer?
Yeah, so I think the biggest mistake I see in markets, and that I hear from asset managers and asset owners around the world, is this assumption that Trump is good for the economy. Trump's probably most prominent campaign pledge, or his most prominent campaign pledges, are number one, to significantly raise tariffs, which is negative for U.S. growth, negative for inflation. And number two is to deport millions of immigrants, which again is inflationary and negative for growth. So it's interesting. I think a lot of people, when they think about the equity market implications of a Trump victory, immediately mention corporate taxes. And just to give you a sense, Trump has talked about lowering the corporate tax rate, and I should say the statutory tax rate, because very few companies actually pay this tax rate, lowering that from 21% to 15%. Goldman Sachs has estimated that tax cut would raise S&P earnings by about 4 percentage points. So it's positive, but it's really on the margin. Far more important, in my view, is his pledge to impose a 10% tariff on all imports into the U.S., regardless of their source, and to put a 60% tariff on goods from China. Now, if you look at economist estimates of the implication or the impact of those tariffs, it would raise U.S. CPI by anywhere from 200 to 300 basis points in the year after it's enacted, and would lower GDP by over 100 basis points. So this is a very stagflationary set of policies. And more importantly to me as an investor is the impact on corporate profit margins. If you think about what a 60% tariff on imports from China would do to supply chains, it would be, in my view, devastating for some companies, because if you're basically selling a discretionary item and you have a 60% tariff on that item, you're either going to take a significant hit to your profit margins to absorb some of that tariff, or you're going to have significantly lower demand for the product. So either way, if you think about companies in the consumer discretionary area where a lot of products are imported from China, or if you think about parts of the tech hardware infrastructure, tech hardware ecosystem, or the industrial sector, these tariffs could have very meaningful negative implications that more than offset the benefit of a tax cut. And so one last piece, by the way, we've talked about the tariff, we talked about the tax cut. On the regulatory front, Trump has talked about significant deregulation. The two biggest beneficiaries of that would probably be the energy sector, in particular fossil fuel energy sector, and also financial services. The energy piece, I think, is well known. He's talked about increasing drilling on federal land, increasing permitting for LNG exports. So that's pretty straightforward. I would just note, by the way, that policy would increase the supply of energy, which also could be negative for the commodity price. But, given that he's talking about allowing more exports, maybe that kind of counterbalances it. On the financial services side, I think this is probably a little less well recognized, is, the Biden administration and the Federal Reserve have been working to implement Basel III endgame, which would require the largest banks in the U.S. to add an additional 5 to 10% to their capital, to their tier one common equity. Under Trump, that would probably not go through. So that would be a positive for the biggest banks. Biden has also wanted to lower the asset threshold for some of the Basel III capital requirements on banks from $250 billion of assets down to $100 billion. The logic being that, last year when Silicon Valley Bank and First Republic failed, effectively in both cases, they were below that $250 billion threshold. And had there been tighter regulation, maybe they would not have had a failure. Under Trump, you would probably not see that. The other element on the financial services, though, is the Republicans have long been opposed to the existence of the Consumer Financial Protection Bureau, the CFPB, that was created in the aftermath of the global financial crisis. That entity presumably could be defunded or even eliminated if Trump wins, and if Republicans control the House and the Senate. And we should probably come back to that. But my operating assumption is there are two scenarios here. Either Kamala Harris wins and has a Republican Senate, Democratic House, or Donald Trump wins and has a Republican Senate and Republican House. If you get that Republican sweep and the CFPB were to be eliminated, that could have a sizably positive impact on the big banks in areas like overdraft fees on demand deposit accounts and on late fees on credit cards. So again, when you zoom back out and think about what the market is pricing, I think you have seen a bit of the market pricing a positive view on financials, although it's kind of hard to tell because we're in the middle of earnings season. We've seen a little bit more positive view on energy stocks, but the offset there has been lower oil prices. So kind of hard to disentangle that. But what I think the market has not priced is what Trump would mean from a tariff perspective. And so, I would focus people's attention on those tariffs as we lead up to Election Day and in the aftermath of Election Day.
And so if Kamala Harris wins, how do you think the markets might react then? Is it obviously she's very pro sort of green, clean energy sort of stuff, and she wants to be more innovative. So perhaps is there like supporting for the tech companies and stuff like that, or actually is it harder to sort of tell with her?
Well, the key to answering that question is your assumptions about the House and Senate. And as I just said, I think I would put an 80% probability that the Republicans control the Senate after this election. And just quickly, as a reminder for people, 1/3 of the Senate seats are up for re-election every 2 years. This year, the math is really challenging for the Democrats. They have a 51-49 majority in the Senate. But of the 33 seats that are up for re-election on a normal schedule, 23 are held by Democrats. And of the 7 races that are very close in the polling, they're all seats held by Democrats. We also know, by the way, one of the Democrats who's retiring, Joe Manchin from West Virginia, will almost certainly be replaced by a Republican because West Virginia is a very Republican state. Manchin had been the most moderate Democrat in the Senate. So just assume that means you're at a 50-50 Senate with 7 more elections that are very close and vulnerable for Senate Democrats. And the reason I go through that is that basically means most of Kamala Harris's legislative agenda is unlikely to be passed in the first 2 years of her presidency if she wins. So corporate tax increases, for example, that she has proposed, highly unlikely to pass the Senate. So to your question, though, when you specifically mention the environment, that is one area where a president can use executive orders to direct agencies in the government in terms of how they implement existing laws. Now, but to be careful here, the Supreme Court has made it harder for those agencies to exercise discretion in recent rulings in the last year. So even there, Kamala Harris's ability to change policy would be relatively limited. I would expect maybe some marginal tightening of environmental regulations. Maybe she would use executive orders to try to deal with certain immigration issues if she could not get bipartisan legislation through. But otherwise, the one venue or avenue where a president has significant discretion is really foreign policy. And there I would expect continuity with the Biden administration, with potentially the exception of a slightly more critical stance vis-a-vis Israel's practices in the conflict in Gaza.
And so what about relations with China? I mean, I think obviously under Trump, they would probably deteriorate. But do you think that they would stay perhaps as they are if Kamala Harris got in?
I think that might be the one area where there's bipartisan agreement is kind of this anti-China view. And it's, it's not surprising, but it is somewhat amazing if you zoom back out and think over the last 10 years, China has gone from being viewed as an economic competitor to a strategic threat, pretty much on both sides of the political aisle. I think under Kamala Harris, you would continue to see a similar foreign policy from the U.S. What Jake Sullivan has described as a small yard high fence, meaning we're basically trying to identify the most sensitive areas of the economy in terms of technology and biotechnology that could be used for military purposes and restricting China's access to those technologies. And that's the high fence around them. I do think that small yard will continue to expand, whether it's Donald Trump or Kamala Harris. But as you note, with Trump, the added element of friction would be the trade policies and the tariffs, which I would not expect to see implemented under Kamala Harris. The key thing to keep in mind with Trump is he fancies himself to be the deal maker. And so presumably his implementation of tariffs against China would be with the intention of getting a deal to somehow reduce the U.S. trade deficit with China. I would just caution that in Trump's first term, the Chinese did agree a deal with the U.S. that they failed to comply with or fulfill. So, it'll be interesting to see if Trump wins, whether his administration would trust the Chinese to even comply with any deal they might negotiate vis-a-vis trade. So bottom line, under either outcome, tensions with China, in my view, continue to ratchet higher. One other thing I would note, the biggest difference under a Kamala Harris administration relative to Trump would also be that Trump tends to act unilaterally. What you've seen under Biden is the U.S. has been very careful to coordinate restrictions on access to technology with our allies in Europe, in particular the Netherlands and with Korea and Japan, because they wisely recognize if you shut off the flow of American technology, but you allow China to buy from all of these other countries, you accomplish nothing. And so I do think you would have a more multilateral approach to containing China under a Kamala Harris administration than under Trump.
Well, brilliant. Well, Ron, thank you ever so much for talking through where we are at the moment. So it's obviously fascinating stuff, and it's great to have you on the podcast.
My pleasure. Thanks for having me.
Dan talking to Ron Temple, Chief Market Strategist at Lazar Asset Management. And as we said earlier, do remember that interview was recorded on the 17th of October. And with things changing so fast, I think it is really important to date these conversations. Right, Tom, we're nearly at the end of, as I promised, a bumper episode. But let's talk about gold now, because it has hit another record high.
Yeah, that's happened several times this year, and there's a number of reasons behind it. So one is that gold has always been a traditional safe haven. So, obviously the world is a somewhat frightening place at the moment, and you've got geopolitical tensions in the Middle East and Eastern Europe, and that's contributing to demand for gold. And, without taking or putting out a political position, the election of Donald Trump, who is seen as somewhat unpredictable in some quarters, is adding to the mix. Gold is also sometimes seen as a hedge against inflation, and there is a perceived risk, at least, that Trump's plan for major tariffs on foreign goods might stoke inflation again. And then in the background, something that's been going on for a little while now, and certainly a very big factor, is that central banks have been buying gold as a way of diversifying the reserves. So most central banks have big reserves of currency and other assets. So they've diversified those reserves out of dollars and into gold. And that's been a trend that, like I said, we've seen for some time. So there's a number of drivers for gold, and it'd be interesting to see how gold performs in the remainder of the year, which, given there's a lot of uncertainty about, you wouldn't rule out necessarily there being further record highs.
We did have an interview recently on this podcast with the Royal Mint, which is worth going back and having a listen to if you didn't hear it. But they put out a press release earlier this week, which I just wanted to mention briefly, because for those of you who don't know, we also have a sister podcast called AJ Bell's Money Matters podcast, where we aim to try and get more women investing. And they put out some numbers saying that more women are now investing in silver and gold. So female investors account for 26% of the Royal Mint's investment customers. And that is up from just 1 in 12 or 8% back in 2018. So, really fascinating that this is having such massive appeal. And I just wanted to end by talking about some new numbers, an update that we got from the Pensions Policy Institute, because they've been looking at lost pension pots again. And they have found that the numbers on lost pension pots has increased substantially. And it's now an estimated £31 billion in lost pension contributions. That's up by 4.5 billion in the last between 2022 and 2024. I mean, that is a huge amount of cash. And the average sum, which surprised me, is £9,470. And of course, if you're slightly older, so aged between 55 and 75, then that is £13,620. And I know there's been a lot of talk about pension dashboards, a lot of talk about pension consolidation, but this is a huge issue, Tom.
Yeah, absolutely. A really huge issue. And, I think one that will probably become more significant as we go on, because obviously people tend to move around more in their careers these days. So the chances of them having pensions, with different providers and with different employers is that much higher. And there are a few routes you can go down to track a lost pension. So if you know the provider your pension was with, you can get in touch with them directly, and they should be able to trace your pension and give you a clear overview of its status and value. If it is a workplace pension, then you're probably best going to the employer in the first instance, and they should be able to put you in touch or get you the contact details of the underlying provider. There is also a government pension tracing service, a free service, and you can search a database of more than 200,000 pension schemes to find contact details. And there's a free service provided by an organisation called the Pension Tracing Service. It's not a government-run website. It's run by some independent financial advisors.
And I know there's been a huge amount of speculation about pensions and potential tax changes in the budget. We spoke about it last week. If you missed that, do listen back, because we had Tom Sieber talking about all of those issues. And AJ Bell has written to the Treasury asking for a pensions tax lock, because it just unnerves people who have got pension savings to think that maybe the playing field is changing when they're only partway through the game. So, do take a listen back to that. That is it for this week's episode. Next week, we will dispense with the speculation, because we'll have actually had the budget, and we're going to deliver our budget special. It's going to be published a bit earlier than normal on Wednesday afternoon. So make sure you're across that. Subscribe wherever you get your podcasts. Until then, thanks very much, Tom.
Thank you. Thanks for having me.
And thanks everyone for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.